This is Larry Williams. He turned 10,000 into 1.1 million in 12 months. I did a deep dive to find out how he did it, and I'm going to show you in this video. Now, this was the Robbins World Cup Trading Championship where he turned 10,000. That's where every student starts with, and to see how much they can get it to in a year. And he did it by 11,000%. And that record has stood for 37 years. Now, the way he did it was with three core strategies. The first one is a volatility breakout. And here's an exact clip from Larry breaking down this strategy.
Stock prices on a daily basis or commodity prices are U-shaped. What do I mean by that? Well, here's an example. In the morning in Los Angeles, there's a lot of traffic on the freeways or in any major city. Then in the afternoon, not much traffic. At the end of the day, there's a lot of traffic again. That's exactly how the markets trade each and every day. There's a lot of volatility early in the morning after a market opens, no volatility, and then at the end of the day, we pick up volatility again. So the best breakout trades, the best trend trades will come early in the morning and after that afternoon session is done. That's the sweet spot of the market. I mean, after all, as a short-term trader, you need big movement. And the best time for the large movement to occur is right when the markets open and again, shortly before they close. It's U-shaped. Trade these parts of the U, not this part. You become a better day trader.
So you can see in the clip that Larry is talking about the exact times where he does this volatility breakout. And he says typically in the morning or late at night or towards the market close is when these moves tend to happen. And so what he would do is look at 10 to 20 day consolidation ranges, measure the average true range, and decide when price breaks out of that average true range, whether it's intraday or over a 10 to 20 day span, and trade it simply by using that. You can see he had a one simple stop loss of 1 ATR below entry. Target was 3 to 5x. He was always going for these bigger risk reward trades. And he had a trailing stop about after, he was up 2R. That's when he had a trailing stop to make sure he covers his losses. So quick interruption, simply telling you to go subscribe below. I've been trading 8 years. I'm giving away all my tips, tools into this exact channel. We're going to start posting almost every day on this channel, going over everything I've learned in the past 8 years as traders. So go ahead, subscribe, back in the video. Here's kind of what that trade would actually look like. Price would be in a consolidation zone. Again, in the clip, he was talking about more intraday, but he also did it over a swing trades. But you can see if price is consolidating, you basically wait for price to break out of that consolidation zone and target a 3 to 5x basically of how much you're risking or whatever your stop loss would be. And he has small risk, large reward, and really all we would have to do is hit a few out of these per month or in different markets in order to make these massive returns. Now that was the main core of his strategy. The other strategy he used was something called a rubber band strategy. It's kind of like a short-term mean reversion.
Professionals, the commercials are accumulating. It doesn't mean we're going to rally now. Now think about this. If you're a commercial, you're Cadbury, and you're going to make a lot of candy, and the price of sugar goes down and goes down more, you're going to buy more sugar because you're still selling a candy bar for $3, but your cost of sugar is now less. It goes down more, you're going to buy more sugar and more. So they tend to buy weakness and sell strength. Remember, they're not buying to sell sugar, they're buying to take delivery of the sugar and use it in their product. So when they're heavy buyers, it says we have a condition here. It doesn't mean rush in and buy today. We still need to bring something like my trend measurements in to say, okay, they've accumulated, trend has changed, now let's get along this market. It's a combination of ingredients.
So basically what you would look to do is wait for price to close 2 standard deviations above or below a 10-day moving average or of a simple strategy or of a stock. And so what that would mean is whenever RSI is below 30 or above 70, as in simple terms, you would wait for price to reverse and end up taking that mean reversion. So kind of here's what that would look like on a chart. Let's say this is the 10-day moving average. You would wait for price to come down 2 standard deviations below that or above that. And then you would look to get a reversal trade in hopes that price moves back to that 10-day moving averages or back to that kind of mean area where price tends to go back to. And it's a very simple strategy. They call it like the rubber band. Basically, when price dumps down, you expect it to move back up. And with this, he had win rates around 65 to 70%. So nothing too crazy. But again, if you're taking a lot of these trades per month, and in the third strategy, you'll kind of see how he's able to do this. But by taking these big trades, that's how it allows you to have these very low risk reward trades and have a very decent win rate with them. Now, the third strategy that he used was something called the leverage multiplier. Now, this isn't actually a strategy. It's more so what he was using to actually get these massive gains. So he was using S&P futures and treasury bond futures and currency futures to get this. Now, with Larry's approach, he was using a huge portion of his account with futures. So he'd use 30 to 50% of his account as margin, which would mean a 5% move in the underlying could mean a 150 to 250% account gain using proper leverage. And so, for example, if you had a 10K account with 2 S&P futures contracts, you can have the buying power to do that, and it would only cost them maybe 5K buying power or whatever it would be, but he would be able to control 2 S&P contracts, which is $500,000 worth of value. So, which means a 5% market move would result in $25,000 in profit, a 250% return on the account. And so essentially what he would do is say, instead of just using cash and making 5% on a move to get $500, he would use futures contracts, which would allow him to get $10,000, control $200,000 worth of essentially buying power. And that was kind of the secret sauce. When you would combine these two different strategies of a short-term mean reversion strategy, so when price dumps really far down or really up high, he trades it back to the mean, or the opposite, or when price is consolidating, he would buy the breakouts or sell the breakdowns and target high risk reward trades. He was able to profit and use this massive leverage. And that's how he was able to grow this account extremely fast compared to everyone else, why no one has been able to beat the record for 37 years. And so here's essentially how he didn't blow up his account, because obviously if you're using that much leverage, there's a good chance you're going to blow up your account. Well, even though he's using all this leverage, he never risked more than 2% per trade. He always has stop losses in place on every single trade, and most of the time was using trailing stop losses. He would try, S&P, bonds, currencies, a lot of different things. He would compound, so when his account was growing, he would use more size with it and scale his position size really fast. And he would cut his losers really fast. If something wasn't working, he would cut it and let his winners run. That's really the key here, is that he was using simple trend following, letting winners run. And even though his win rate wasn't incredible, 55 to 60%, his winners were so much bigger than his losers, that allowed him to have a very strong positive expectancy and also compound extremely fast, which allowed him to obviously grow his account like 11,000%. So putting it all together, how was he able to actually do this? Well, using volatility breakouts as his main strategy, and then also a mean reversion strategy on high volume, that was the core concept he used. And when you combine that with very proper risk management, very solid diversification, also using futures, so you can have essentially the ability to compound like crazy, allowed him to get an 11,000% return that no one else has been able to touch for years. So multiple strategies plus leverage plus strict risk management allowed him to get these amazing returns. Now, if you did enjoy this video, go ahead and subscribe down below. I know it's a little bit shorter, but it's going over the legendary Larry Williams, showing you the exact strategies he used. And yeah, I bring out new videos like this every single week. So go ahead, subscribe down below, and I'll see you all in the next video.